Hello, everybody. Welcome to StockMarketJobber.com. My name is Mark, and today I just want to talk a little bit about technical analysis because there is a lot of mythology behind it. And it's unfortunate because if viewed correctly, it could really help you trade. And when I say that it's unfortunate because there are people that talk about things like Gann theory and Elliott waves and Fibonacci. And now I'm someone who was in the institutional trading world for 20 years. I traded for two of the best money managers in history, basically, Mario Gabelli and Steve Cohen. I was also the head of trading at three different money managers where I oversaw all kinds of different trading strategies, including hedge funds. I was a market maker, traded mutual funds. So I've been around the block a few times. And technical analysis, if viewed correctly, it should just be a chart is a graphical illustration of psychology, okay, if it's viewed right. And I can show you that right here. Now, we have this interesting phenomena that occurs in the markets, and you can see it on a lot of different charts, where a level that was support here can convert, well, this is support here too, convert into resistance over here. Now, how does this happen? Well, when a market's going lower, it's because there's not enough demand to absorb all of the supply. In other words, there's not enough buyers to buy all the shares that are for sale. So the sellers are forced to offer their shares at a discount, and this forces a downtrend. When we get to a support level like here, okay, there all of a sudden there is enough demand or buy orders to absorb all of the sell orders or demand. Now, a lot of times we get this. When we get to a support level, we get a quick bounce. See, like there, like here, here. This happens because, well, let's talk about what support is. Support is a level where there's enough demand or enough buy orders to absorb all the supply. Now, some of these investors who want to buy, they start to think, the stock's not going down anymore. That means there's other buyers coming into the market. I don't want to miss it, so instead of paying current levels, I'll pay up $1 or I'll pay 211. Someone else sees that and they say they'll pay 212 and so forth. And we get the snowball effect. So this is pretty common. When a market is going higher, it's because there's not enough supply to fill all the demand. But what I want to focus on is this phenomena of how support could turn into resistance. Now remember, a resistance level is a level where there's enough supply or sell orders to fill all of the demand. So when we're going higher, there's not enough supply or sell orders to fill all of the demand or buy orders, but when we get to resistance, there is. So resistance level is the opposite of a support level. Now this, remember what I said, it's psychology. This happens because of buyer's remorse. There are a lot of investors who bought at the support who regret doing so once the shares went lower. And a lot of them tell themselves, man, I made a mistake. I shouldn't have bought this, but I don't want to lose any money on it. So what I'm going to do is I'm going to sell it if it gets back up to my buy price. That way I can get out at break even. So if there's enough of these remorseful buyers placing sell orders, then the level that was support turns into resistance. So support here, and then the support here finally got broken. The sellers overcame the buyers. But as we got back up, these remorseful buyers are like, all right, here's my chance to get out at break even. I'm going to take it. So support turning into resistance is a very common thing in the market. And in my teachings, I want to teach you about what institutional traders focus on, and this is what we look at. What are the important price levels? What's the momentum? What's the trend? I mean, we'll talk more about that in a different lesson. Um, but let me show you something that's interesting. Now, because charting is an illustration of human psychology, the same principles that apply on all different timescales because different investors have different time horizons. Some are day traders, some are long-term traders. So let's take a look at Tesla over the last 5 days. And if you're interested, what is today, March 6th or March 7th? Anyway, here's Tesla. Okay, yeah, today's March 7th. You can see down here. March 7th of 2023. So now here is a 5-day chart. And as we can see here, look what happens. The same thing. Support converted into resistance. So this is the $200 level, right? People like nice round psychological levels. But support turn into resistance because people that are trading in this time frame, this 5-day time frame, a lot of the investors who bought back here or traders who bought back here regretted doing so once we got this move down, and they tell themselves, I made a mistake. I want to get out. If I can get out at the same price I bought them at, I'm going to sell so I get out at break even. So here's the 5-day thing. So it's the same principle, but it's on a different time frame. Charting is fractal. The stuff that goes on in short time periods could be the exact same stuff that goes on in longer time periods because it's just an aggregate of a bunch of humans that have different time frames. But the same rules apply whether you're a day trader or whether you're someone who's a swing trader who has a time horizon of maybe a couple weeks or a month. If you're a longer term investor, the same thing could happen on a longer term chart. That's something we call market memory. But it's the same principles. Now look at this. So right now it's about 11 in the morning. And here is the Tesla for the last hour. Well, actually, I made this about 15 minutes ago. Support, oops, come on, I'm trying to get my pen up here. Okay, support becomes resistance. This is probably day traders who bought in here who regretted doing so when the price went lower. So they tell themselves they're going to get out at break even. And sure enough, we can see that that's what happened. There's resistance at the level that was support. Now, how can you use this? Well, say you have something and you're thinking about where to sell it and the thing's in an uptrend. Well, instead of just guessing on a target, look into the past, look on your chart and see if there's a level that had been clear support. Because there's a good chance that when your stock gets that level, it runs into resistance, and that is probably a good place to sell it. All right, so please sign up for our YouTube page here, Stock Market Jobber. Check out our site, stockmarketjobber.com, and I will talk to you soon. Thank you, everybody.